I've heard you say, Ray, that central banks control the capital market now. What does that mean?
Um, in the normal world, at normal times, the way the system works is central banks put money on deposit, and banks come along and they borrow that money and lend it to those who they expect will pay back. And that then passes through the credit system. And then all financial assets compete with each other. And it spreads out. Credit gets expanded. And then there's the issue of payback. And then we have the cycles. Money's too loose. Inflation rises. Central banks put money on deposit, tighten money, and it slows down, and we go through our cycles. That's no longer the case for the most part. Today, the economy and the markets are driven by the central banks and the coordination with the central government. What I mean by that is the purchases right now of financial assets by the Federal Reserve or the purchases by the Federal Reserve of government securities are the drivers of that market. So the production of the money, if you look at money and you look at who is in the market. So the Federal Reserve, for example, will set an interest rate that for different types of creditors based on its economic objective. In the old days, let's say when we had the 2008 financial crisis, we needed to protect banks because they were systemically important, and then money market funds and commercial paper and the like. Now it's much broader than that. The whole economy is systemically important. If they didn't go out and make lending to companies, including what we call fallen angels, those that were just above investment grade and fell into investment grade, we would lose large parts of our economy. And so we're in a situation now where they're the market makers. Take the market out, take the central banks out, and you have a different story, including the value of money. What is the value of money? I mean, think about it in Europe, for example. The central bank will lend to banks at a minus 1%. And so that means you don't have interest payments. In fact, you have interest credits. And the central banks will take that debt on. They'll own it. And they have a political agenda, not an economic agenda, in which they'll determine whether they'll be paid back or when they want to be paid back based on how the economy is doing and what will happen. So in that case, like an example in Europe and the similar situations in the United States and Japan in varying degrees, they will make loans that will have interest credits almost, or let's say zero. You don't have to pay interest back. And you may not have to pay principal back. It depends on what the conditions are at the time. So those are markets which are driven by central banks, not only their actions, but their desire to be an owner of those assets, and their priorities about that ownership when they buy and when they sell are not the same as the classic free market allocations. And as a result, the capital markets are not free markets allocating resources in the traditional ways.